Canadian National Railway is down more than 6% year to date, and it is one in fact that Bill Gates himself does hold. From his latest portfolio update, Q1, we can in fact see he holds around 16%. It is one that I also hold within my own portfolio alongside Union Pacific in this industry, and it is one we are looking to add more to, which we'll discuss throughout this episode. As we can see though, it is down 6%, it is trading right there in the midpoint of the 52-week low, and as always in our deep dives we are going to run through not just the dividend safety, but also a lot of the metrics, discuss what we do like about this company, some things we would like improved, the free cash flows, the ROICs, the debt levels as well. We'll also run through the numbers on a top line revenue basis as well as a bottom line net income. We'll also looking at the health of this company, their total cash versus their total debt, and we'll also look towards what the institutions are doing if they are adding more of this to their portfolios on a quarter by quarter basis. And I think it's also important to understand from their latest investor presentation what exactly their numbers are looking like for the full year guidance as well as for the full year of 2024. Importantly, we are going to run it through the valuation model. We'll get to our intrinsic value, our own acceptable buy price, given our investor margin of safety, as well as looking to Wall Street, see what they're indicating for the upside over the next 12 months. So in terms of CNI, as we can see, a 1 buy rating from Seeking Alpha, a double hold from Wall Street and Quant. It does have a yield on a trailing 12-month basis, 2.04%. Forward P just above 20. Now bear in mind S&P around 22.5, but as always we will compare it for more relevancy to the sector P itself. And you have been holding over the last 10 years, while you would be up around 83%. Bear in mind if you reinvest dividends, you would be up marginally higher, and we can see all-time highs sitting somewhere around that $137 mark around 2 years ago today. So in terms of the institutions, let's start off there. Around 81% ownership, 3.53 billion worth of outflows over the last 12 months. A lot more buying, around 4.86 billion over the same period. And what we also note in the more recent quarter, we do see more buying by the institutions, Q1 24, as well as the previous quarter of Q4. So institutions have been buying more, not just over the last 12 months, but also on a quarterly basis as well. In terms of what we want to see on the top line, as always, 3 to 7% year on year. One thing to bear in mind, it is a fairly cyclical company, and what we can see around 20% growth, 10.5 billion in 2014 to around 12.7 in that latest annual report. As always, we will look at this percentage as well, increase year on year later on, and we can see it is increasing over the longer term. Just understand with this company, we're not looking at a tech company, so don't expect massive growth over the long term as well as large percentage increases. In terms of the bottom line, nice to note, whilst their top line is only up around 20%, 2.7 billion in 2014, we see nearly double that, so 100% increase into 23 at 4.25 billion. And we can see here again, looking at it on a graphical basis, whilst it has increased over the longer term, again the cyclicality does show some very strong years followed by years with large downturns. So just something to understand moving forward. In terms of the health of this company, cash versus total debt, 45 million in 2014, large increase to their latest quarterly report of 304 million, and we can see over the longer term it has been increasing, but again a lot of inconsistency. And as always, this number isn't something we just look in isolation. We like to compare it to that total debt, both numerically and directionally. So what we see here, in fact, 7.2 billion in terms of their total debt. It has pretty much doubled to around 14.9 billion in that latest quarterly report, something that we do expect with this industry, but as always, we do need to consider this into the dividend safety as well as other underlying metrics. And again, graphically, it has been on the upwards trend over the last 10 years. Now, what we always like to do, earnings per share, how does it compare to the analyst targets? How have they performed in the past? And what are the future projections? So over the last 4 quarters, they have in fact beaten or in line for 2 out of 4, so a 50% track record. And as we can see, those were the last 2 quarters as well. Whether or not this gives you confidence in their estimations forward looking, we can see their performance historically. Moving forwards then, they're expecting high single digit increase to the earnings per share in their next quarter, double digit into Q3, and again some nice numbers over the next 2. Now if they do hit this EPS estimate for 2025, their forward PE will drop down to around 18, but as always, past performance or past accuracy doesn't really give us any accuracy towards the future. We just like to see how this is. Whether or not you want to incorporate that into your analysis, information is always there. In terms of the valuation, so this is the first grade that we're looking at with the underlying metrics. They get a C-. Now the first thing that we are looking here is the P. Now 20.16, we can see the sector median 18.61, so it is trading at around a premium of 8.33%. As always though, we do need to understand whether or not it is justified or warranted, and as we can see on the other valuation metrics, they are trading pretty much at a premium in comparison to the others. When we then move on to the growth grade, now they get a D+, so pretty poor in my opinion. Revenue growth year on year, -5%, sector median at that 5% plus level. When we look to the forwards looking aspect, 2.44, sector median 6.24. So not just valued higher than essentially the sector median, but in fact their revenue growth over the last year and forward looking is anticipated to be lower. In terms of the other metrics, final one that we really will point out today, earnings per share expected over the next 3 to 5 years to increase at 11%, sector median marginally higher at 11.6. So you could already ask why on earth then, if the sector median is producing better numbers and they are in fact, as we can see, valued much lower, why would anyone want to invest in this company? And we will hopefully answer that throughout the episode. First answer here, profitability. They have an A+, so one of the best in the sector, 56%, sector median at 31%. Bottom line, very, very strong. 33% is incredibly strong for a railroad company, 6.07 for the sector median. And we can as well see cash from operations, 5.2 billion versus the sector at 327 million. So in terms of this part of the analysis, we do get one buy rating, that is from Seeking Alpha, a double hold from Wall Street and Quant, a C- on valuation, a D+ on growth, with an A+ on profitability. Now what we also like to do on this channel is compare their performance against others in the sector, as well as trying to identify any themes. We have Canadian Pacific, CSX Corporation, Norfolk Southern, and another one we hold in the portfolio, Union Pacific Corporation. So over the last 12 months, we can see they are pretty much up around 2%. Now bear in mind, this does include dividends reinvested, and the trend we can see here, every single one in this industry is barely up single digits. UMP though, we can see the best performing up 14. When we expand this over the last 5 years, fairly similar story to be told. They do have fairly similar increases over the period, but as we can see here, Canadian Pacific the best performing, and we do have coming in at second UNP. In terms of over the last 10 years, CNI in fact the worst performing, and interesting to note here, CSX is first, which it wasn't even in the top 2 over the last few numbers we did look at. But as always, what all these numbers mean, yes, it is historical data, so don't take this as anything to do with future projections, just something we do like to incorporate so you can see how well or how poor these companies have performed. Now, as always, we're incorporating the S&P data as well, so over the last 12 months, they are up 25% if you have invested in the S&P, CNI up 2%. Over the last 5 years, S&P again very strong 85, CNI 38. Over the last 10 years, we can see again S&P outperforming. Reason for this, as always, if you're not having that guarantee in your analysis that you have with very strong confidence a company to outperform the S&P, always look towards a low-cost ETF instead, like VO, and I'm sure there are many, many others to consider as well. Now, before we jump into the dividend safety, we want to run through the investor presentation. Now, this was from April, a lot of interesting data to be shown here. Firstly, now this will take part as the analysis later on, but at a very high level, their total revenues over the last 5 years have increased around 3%. Now, what we typically say, 3 to 4 as a bare minimum, just to keep up in line with inflation, which they have been able to do over the last 5 period. Earnings per share, well, nice to note, 10% increase, CAGR, compounded annual growth rate, so that is positive. Bottom line, 8%, again, nice to note. In terms of the volume, well, that is down 1%, adjusted diluted earnings per share up 6%, and free cash flow, one of the most important metrics for us, is up around 18%. Very, very nice to know. We then move on to looking at their balance sheet. Again, we will cover this, but we just want to pull it out from their investor slide deck as well. We can see their long-term debt rating is very high as well, around the A, and their adjusted debt to EBITDA multiple, again, we will cover this, very low, which is always nice to see. You don't want to be investing in companies where they have a significant amount of debt, which will apply pressure throughout the business, not just to their dividend safety. In terms of rewarding shareholders, this is a lot of very nice information. They did have an increase, 7% in fact, in 2024, which is actually lower than what they typically do increase. Their payout ratio is very low, although we do prefer to look at the free cash flow, which we will incorporate. And one of the most beautiful things about this company is they do a lot of share buybacks, which they will continue to do over the next year or two. 35 billion in fact since 2000, and as we can see, around 4 billion to be done over 1st of February 24 to January 2025. Now, in terms of looking at their full year 2024 performance, they're anticipating 10% earnings per share growth, return on invested capital 15 to 17%, and as we saw already, a 7% dividend growth with share buybacks of around 32 million common shares. Now, in terms of their outlook moving forward, so you can sort of understand what to expect with this company, as always, these are purely just projections. 10 to 15% earnings per share increase year on year over the next few years. ROIC 15 to 17%. We'll come on to that, but that is very nice to know. And the net debt, or the debt here, in fact, to EBITDA around 2.5. They're targeting here 10 to 15% on the earnings per share, which is very, very great to see. In fact, when we did look at the data from Seeking Alpha, they were estimating between 11 to 12%. Now, we just want to let you know, we have released our latest free weekly article. If you want access to this or any of our other articles, all completely free, do click on that pinned comment below. For example, how to find undervalued stocks. If you want to take a look at the screeners that we use, any of the websites, we do list them all here, so you can also come along for the ride when we do take a look at our analysis. Or 12 undervalued dividend stocks. If you do want to see some high quality that do look undervalued on the triple signal, then do take a look at that. So let's jump into the dividend safety and supporting metrics. 97, very safe, love to see that. Market cap 75 billion. It is a large cap company, and it was reaffirmed last month. In fact, very safe dividend score, therefore a dividend cut does look to be highly unlikely. In terms of the key metrics from the last recession, important for those that do see one inbound, they increased the dividend during the 07-09 Great Recession, negative 13% recession sales. Bear in mind that was the average, around negative 12 for the S&P, and they did marginally outperform the S&P, negative 45, S&P itself coming in at negative 55. As we said, 7% increase this January, but historically they increase it very strong double digits, so this is a common theme with CNI, which I do believe they will be able to continue into the future. They're also a dividend aristocrat. They have been increasing those dividends for the last 25 years or more. And importantly, when we do come to take a look at dividend yield theory, it states a company is undervalued when the current yield sits above the 5-year average. So we have an undervaluation signal on the yield. We also have an undervaluation signal with the forward PE below the 5-year average of 20.9. And we do note the industrials is only marginally lower as a sector at 19.1. Now, regardless of these undervaluation signals, we're not looking at any of them in singularity. We will conclude towards the end. As always, free cash flow payout over the earnings, which they like to show on their investment deck, purely because this is susceptible to manipulation by management through their accounting. And what we always want to see is below 60%. Give us that faith that they can offer those double-digit dividends we love to see. Bar 2019, it has been below 60%, 55 in 23, 57 anticipated over the next 12 months, so already off to a very good start. Free cash flow, remember how we did look at their numbers, growing very strongly. As always, consistent increases over the longer term. They have pretty much more than doubled it over the last 10 years, anticipated over the next 12 months to continue that upward trend. In terms of sales growth, while we did say that this is a cyclical company, we can see 3 of the last 10 years negative, and in fact on a trailing 12 month as well, negative 5%. Just something to incorporate in your own investment thesis as well as your margin of safety. And in terms of total sales, we did see this already, but again, another format to see. And one of the things we do quite like, not just that they are doing share buybacks, but they have also historically done them, and that is a good way to return excess cash to investor pockets on top of those very nice dividend increases year on year. ROIC, now this is one of the 7 golden metrics we love to look at. What this eventually shows us is that it's giving us faith that management are able to effectively allocate their capital. 10% or higher is the number we want to see. Yes, it has been decreasing, but nonetheless, the consistency around the mid-teens is very strong, making it very attractive for consideration to the portfolio. Operating margin, as always, 12% or more is a minimum. Very strong, very consistent in the 40s, very nice to note. Free cash flow margin, absolute free cash flow machine every single year. The last 4 years in the 20s, as well as on a trailing 12 month. Always love to see this with any company. Now, importantly, the net debt to EBITDA, the earnings before interest, tax, depreciation, amortization, below 3 is what we want to see for the majority of companies, and these numbers reflect the number of years it would take the company to pay off all of their debt net of cash on hand. This also correlates to the balance sheet strength, dividend safety, and in fact we can see 2.16 in 2023, 2.1 anticipated over the next 12 months. No worries with the dividend. The balance sheet does look to be very strong, as we can see as well. So far, so good. Now let's jump into the valuation model. As always, if you do enjoy the content, value is being provided. Smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. First model, the multiples valuation model. Companies in a similar sector and size, average P multiplied by the EPS of CNI, and we get an intrinsic value in today's episode of $124. Undervalued, although you could argue very marginal, but do remember we don't look at any of these models in singularity. We then have the DDM model, the growth rate, very nice, 9% just over the last few years. Moving forwards, we have gone for 6%, so a little bit more conservative than the average. This does give us an intrinsic value of $132, as we can see market value showing a sign of undervaluation. We then move on to the DCF model, free cash flow year on year. Average growth around 7%. We have gone in line with analysts and management's target around 10 to 12%. In terms of using the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by those shares outstanding, and we can see another marginal undervaluation signal. So the intrinsic value in today's episode is the average of these three, and it does arrive at a price of $127. And don't forget, you can grab a copy in the pinned comments of the valuation model, getting to both intrinsic value and the acceptable buy price of companies in your own portfolio. So margin of safety, as always, we do start off with 10%, which we do execute if it meets our 3 golden criteria. A wide moat, strong financial metrics, good forward-looking data. Now, if you do believe that for CNI, it is a buy around $114. But as always, you may want a little bit more. At 15%, it is around $107.55. At 20%, around $101. Now, again, this is a cyclical company, so it is always good to buy this when it is in a downturn. At a 10% margin of safety, a buy of $114. For us, though, we are looking to add around a 15% MOS level, which is where we did add earlier on, so around the $106, $107 mark. As we said, though, in today's episode, it is near that 10% MOS. And in terms of Wall Street and their forecasts, well, over the next 12 months, they actually see a lot of upside, 18%, $138, so higher than our intrinsic value, and they do consider this one that you should think about for the portfolio. As always, though, let us know your thoughts. Is this one you are looking to add? Maybe it's on your watch list, or maybe you do prefer other railroad companies like UNP, like CP, or the others that we did briefly cover. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.